Hi, I'm Grant Mundell, investment specialist at Equity Trustees with the June monthly market review. Equity markets finished the financial year on positive terms, with international equities gaining 2% in local currency terms and Australian equities up 1%. International markets were once again propped up by the US megatech stocks, with the Nasdaq rising 6%, but Asian markets also performed well. Conversely, European markets underperformed, weighed down by the French CAC, which fell 6% following a surprise snap legislative election. In Australia, the financials were the best performing sector, and materials, which are mainly made up of resource companies, fared worst. The banks have strongly outperformed the resources over the last 6 and 12 months, with the banks benefiting from a better than expected domestic economy, while resources have suffered from a soft Chinese property market. Chinese economic concerns saw commodities, excluding oil, fall in June. The LME base metals index fell 4.6%, while iron ore fell 8% to US $106 a tonne. Notably, central bank activity is starting to diverge. The RBA kept rates steady at 4.35%. However, the market quickly priced in around a 50% chance of a near-term rate hike following higher than expected inflation numbers. The Federal Reserve kept US rates unchanged at 5.5%. However, the economy there is slowing. And despite revising up its inflation and wage forecasts, the European Central Bank cut rates, as did the Bank of Canada. The current consensus view is that inflation in markets will fall, leading to rate cuts, while economic growth remains resilient. We're a little bit more cautious given the US economy is slowing. There are increasing signs of consumer weakness. Inflation hasn't yet been conquered, and therefore rates may stay higher for longer. Migration rates are now starting to slow. China faces ongoing structural headwinds, and policy stimulus is proving ineffective thus far. Geopolitical risks remain, and equity valuations relative to bonds are not overly attractive. We are therefore tactically slightly underweight equities and overweight defensive assets such as fixed income, credit, and cash, which we think offer better risk-adjusted returns at present.